Hello and welcome back to Global Value. In today's video, we are going to be performing a fundamental stock analysis of Frontline Ltd, ticker symbol FRO. At the time of recording today's video, Frontline is trading for $9.43 per share. Year to date, their stock price is up 33% in stark contrast to the overall market. Over the past year, their stock price is up 22%, and going back 5 years, their stock price is up about 8.5% compounded annually. So Frontline is trading snugly between their 52-week high and their 52-week low. They're about a $2.1 billion market cap, and they have about 3.5% of their shares outstanding sold short. For some more background about the business, Frontline Ltd is a shipping company that engages in the seaborne transportation of crude oil and oil products worldwide. It owns and operates oil and product tankers. As of last year, the company operated a fleet of 70 vessels. It was also involved in the charter, purchase, and sale of vessels, and the company was founded in 1985 and is based in Hamilton, Bermuda. For an interesting bit of history about Frontline, this was a business that Monish Pabrai invested in the early 2000s. Following the dot-com crash, the investment ended up being wildly successful for Monish. He did an interview where he details exactly what happened in his Frontline investment. But what's interesting to note is that if he would have held on to the business and had not sold until a couple years later, just prior to the global financial crisis, he would have ended up making an absolute fortune on the business. From 2002 until 2007, Frontline stock price rose from about $13 per share all the way up to $360 per share. So an absolutely massive run-up in a period of constrained supply for the global oil shipping market. So with that bit of history, let's get into today's fundamental analysis. We're going to be performing a modified version of the 8-pillar analysis, originally popularized by Everything Money, taking a look at 8 key financial metrics of Frontline and coming to a holistic and beginning understanding of the business based on those fundamentals. So let's get right into it. Starting off with pillar number 1, we want their average PE over the last 5 years to be below 22.5. So currently, Frontline has a very negative PE. They have negative earnings. Over this time frame, their earnings have fluctuated extremely wildly. They're trading at a multiple of 500 times earnings, as well as trading for a huge deficit. Even accounting for those fluctuations, the business has traded at an average of about 16.5 times earnings. So although that does fall into our range, 1, it's not that accurate as a valuation metric because of these huge swings. And 2, they currently have a negative PE. So this is actually going to be an X to start off on pillar number 1. If that PE would have been positive, we would have given them their check. Pillar number 2, we're looking for an average 5-year return on capital that's above 9%. Over the long run, over the course of decades, a stock is going to return approximately what its underlying business returns, and those underlying business returns are going to be captured here by return on capital. Frontline's return on capital has also fluctuated over this time frame. They had mediocre returns on capital, although in 2020 they did produce above average returns on capital, and last year their returns were almost non-existent. Averaged out over this time frame, Frontline is only earning about 5% returns on capital, so that is going to be our second X in a row here on pillar number 2. Pillar number 3, we're looking for 5-year revenue growth. Frontline has grown revenues from $645 million in 2017 up to about $749 million in 2021. So that is going to be our first check here on pillar number 3. Pillar number 4, we're looking for 5-year net income growth. Frontline has had negative net income in 3 of these 5 years. In 2017, they had a loss of about $265 million. And over this time frame, again, while their earnings have fluctuated quite wildly, in 2021, they only lost $11 million. We'd rather have businesses with positive earnings, but this one's still technically going to be a check as they've narrowed that loss. So back-to-back checks here on pillars 3 and 4. Pillar number 5, we're looking for decreasing shares outstanding. When you purchase a share of stock, what you're really buying is a fractional ownership percentage in a business. When a business buys back stock by repurchasing shares, they're increasing your ownership percentage in the business without you having to pay a dime. So this ultimately means that they're increasing the percentage of the business's profits that you're going to be entitled to. Here, unfortunately, we're seeing the opposite. Frontline has diluted shareholders by about 17% over this time frame. So that's an X here on pillar number 5. Be careful when evaluating businesses and always be sure to look at how many shares outstanding they have, as this can be a silent killer, especially if you're holding a company that's heavily diluting shareholders. So far through 5 pillars, we have 2 checks. Let's keep going. Pillar number 6, we're looking for 5-year free cash flow growth. Free cash flow is cash from operations minus capital expenditures. It's the lifeblood of any business and can be used to pay dividends, buy back shares, pay down debt, make acquisitions, or reinvest back into the business. A business's abilities to produce free cash flows now and until Judgment Day, discounted back by a reasonable interest rate, is ultimately how much that business is going to be worth. So in 2017, due to a very large amount of capital expenditures, Frontline had negative free cash flow of $583 million. And in the course of time until now, both their cash from operations as well as their overall capital expenditures have fluctuated quite a bit. Last year, they consumed about $400 million of free cash flow. So the business needed that much more money injected into it in order for it to operate. Again, while this is negative, this is technically going to be a check, as they have decreased the amount of cash they're now consuming in their business. In an average year, Frontline is consuming about $240 million of cash flow. That, in conjunction with their high capital expenditures and their below average returns on capital, really aren't boding well for this business overall. This is really what you want to avoid, especially when accounting for things like inflation. Next up, pillar number 7, we want their net debt, which is long and short-term liabilities minus cash and short-term cash equivalents, to be below their average 5-year free cash flow multiplied by 5. So Frontline has about $2.25 billion of net debt. Because they're actively consuming cash and not producing free cash flows, pillar number 7 is going to be an X. Based on their free cash flow profile, Frontline is not in a good position to be paying off this debt, and therefore the business is more highly levered than we'd want. During periods of hard economic circumstances, it's these highly levered businesses that are not bringing in active cash flows that are going to perform the worst and are going to have the most business risk overall. And finally, pillar number 8, we want their market cap to be below their average 5-year free cash flow multiplied by 20. Currently, Frontline has a market cap of about $2.1 billion. This here, again, is going to be an X because the business over this time frame has negative free cash flows. So the business is actively consuming cash. They're not spitting off cash for their owners. Then lastly, here, just taking a look at Frontline's tangible book value. If the business is not able to produce free cash flows, why does it have any value at all? First off, they have been able to produce positive free cash flows in 2 of these 5 years. So existing shareholders are making the bet that the business is going to be able to return to a cash flow positive state at some point in the future. In addition to that, Frontline also has a tangible book value of $7.57 per share as of the end of last year. So based on their current stock price, Frontline is trading at about 1.25 times book. Book value here is going to be common equity, net of goodwill and intangibles. So in summary, Frontline checks the box on 3 out of 8 pillars. They operate in a highly cyclical industry that currently is experiencing a boom times. The shipping market is experiencing a period of good economics overall. So it is concerning here that Frontline is earning below average returns on capital. They're not producing free cash flow. They're diluting shareholders, and that they do have quite a bit of debt, especially compared to their overall market cap. So again, this type of analysis is not financial advice. It serves as a beginning and holistic understanding of the business to really determine whether it's worth your while to dig in and learn more about Frontline. It's not financial advice, and it should not be construed as a buy or sell recommendation of Frontline. So if you want to learn more about the business, I highly recommend checking out the business's filings, read through their 10K, understand how management is approaching the business, understand how they're approaching capital allocation, and just as importantly, in a highly cyclical industry like this, understand the overall environment that Frontline is operating in. Unless you have some insight there, that might be extremely difficult to do, but ultimately that's what you're trying to do as a value investor. You're trying to understand businesses as if you owned 100% of them really getting to know the ins and outs of a business and understanding its essence. So with that said, that's it for today's fundamental stock analysis of Frontline Ltd, ticker symbol FRO. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Frontline with me, and have a great day.